Joining us here at Post 9 is Wilshire's Chief Investment Officer, Josh Emanuel. Wilshire has $86 billion, as we said, $1.2 trillion in assets under advisement. Great to have you back. Good to see you.
Thank you.
You are sort of migrating your allocation out of equities and into bonds. Why?
We are, gradually. If you just look at valuations where they are today, U.S. equity valuations at roughly 20 times earnings, that's, almost 10% above the long-term average. In terms of valuation. So, 20 times multiple relative to the long-term average of about 18 over 10 years and about 16 times earnings over 15 years. So I think investors just need to be aware of some of the optimism that's priced into markets today, which contrasts with what we saw at the beginning of 2023. Early 2023, many investors were bearish. Sentiment was very negative, and that's an environment where you have the risk that things surprise to the upside. We think in this environment, when you look at the sentiment surveys, when you look at valuations today, a lot of the optimism around the Fed cutting rates, we have concerns that perhaps things have gone a little too far here. So we're moderating some of the equity risk in portfolios. We find bonds to be attractive from a valuation perspective here. And so just gradually starting to pare back risk. And we think this is the right opportunity for investors to think about diversification in their portfolio.
So a lot of talk about positioning today, global equity positioning, getting close to post-Lehman highs. On the other hand, we keep hearing about sideline cash that would come to the rescue one day. Is there anything wrong with that thought?
No, I think when you look at money market assets, a lot of people look at money market assets. There's been a lot that has moved into money markets out of just bank accounts, right? So you've had a flow into money markets purely because cash rates are so high that you can get in a money market versus the deposit rate that you can get. So there's risk that there's cash on the sidelines that comes back into this market. But if you look at portfolios today, equities versus fixed income, and incorporating that bond allocation that also captures some cash, I think what you more likely would see is investors moving out of the front end of the curve or cash or money markets out in duration, taking a little bit more interest rate in this environment where, I think on balance, if you look at where the 10-year Treasury is today, 4.2, 4.25%, pretty attractive yield relative to where we were several years ago.
So I guess my question is the big risk now that inflation remains sticky and that the Fed isn't able to cut rates? And how big of a concern is that after Tuesday? Because Fed doesn't sound particularly concerned about it, but I feel like there's this nagging concern from the markets.
Yes, Sarah, I think there is definitely, in our opinion, too much optimism or dovishness that's priced into interest rate expectations today. If you look at the inflation data, core inflation is still running at 3.9% year on year. If you look at a 3-month moving average of core inflation, it's still above 3.5%. So, and if you look at this most recent inflation print this week, we had a surprise to the upside on both the core and the headline number. And to your points earlier, a big part of that was shelter, right? Owner equivalent rents. But it's hard to see any real path towards weakness in the real estate market or in rents at this point in time. And so the risk here is that the economic data continues to surprise to the upside. We've had non-farm payroll surprise to the upside 2 months in a row. We had very strong GDP data. The consumer's actually in pretty good health. I know there's been a lot of discussion about delinquencies, but if you look at household debt ratios, let's not forget, the biggest part of consumer debt service is really mortgages, and most consumers are sitting on very low mortgage rates. So they have the capacity to borrow here. That powers the consumer. And that, I think, is the big risk here, is that if growth is surprising to the upside, if unemployment or the employment market is doing better than expected, ISM data indicates that business conditions are improving. Overall, this is still a pretty healthy economy. And despite the retail sales data this morning, if you look underneath that data, what you saw was that spending at restaurants and bars was actually a pretty healthy number, which really captures what's going on in services. And so while perhaps consumers are pulling back on demand for goods or things because we just came out of a holiday season, it looks like they're still spending on services.
Yeah.